Hello everyone. We know over the past few weeks we got this rising treasury yield issue. Especially October last week, the situation became even worse as the US 10-year treasury bond yield reached a 16-year high of over 5%. Additionally, both 20 and 30-year bond yield also increased crazy during this period. In response to that, in the last 2 weeks, there was a huge bond sell-off. As a consequence, in the October last week, US market crashed. Nasdaq dropped over 8% and S&P 500 moved down near 6%, which made most of the stock market all around the world to down. However, for now, after this US Fed chairman speech in the FOMC meeting, bond yield improved mildly to around 4.66%, and so global momentum also improved. But what if it again increases means? So that's what we're gonna see in this video. First, what is meant by US government bond? What is US Treasury yield and why this bond sell-off now? Basically, I'm going to break it all down and make it simple so we can understand easily. So without delay, let's get started. First, let's understand the difference between Treasury yield versus government bonds. Then we will see why Treasury yield and government bond price of existing debt have inverse relation. A government bond is a kind of debt security issued by a government to support the government spending and its obligations. So, either as public or the investment company will lend the money to the government in exchange for periodic interest rate payments plus the return of the bond's face value when it matures. Again, government bond and its name vary by each country. Example, for US, it's US Treasury bond. For UK, it's UK Glitz. For Germany, it's German Bunds. And for India, it's called GSEC, Government Securities. And also, these bonds vary by the length of time until maturity. 3-month, 1 year, 2 year, 10 year, etc. Then the treasury yield is the return on investments expressed as a percentage on the government's debt obligations. Simply how much government has to pay on its debt to the bondholder. So the treasury yield can change throughout the day as bonds are bought and sold on the open market, while the terms of a government bond, including its coupon rate, are fixed when the bond is issued. Basically, investors buy government bonds as a way to earn interest and preserve capital, while they monitor treasury yields to gauge market sentiment and make investment decisions. I think it's still confusing for some, so let's see with the example. Let's say in 2022, I bought a $1,000 US government bond that has a 5% coupon rate. In simple Indian term, it's 5% interest payment every year. So, as per that, the bond I purchased pays me a $50 in interest each year regardless of changes in market conditions. Now, after the bond issue, US government increases the interest rate, say to 6%. Thus, the bond market interest rate also raised it to 6%. So, now new bonds would be issued at this higher rate, paying $60 per year on a $1,000 bond. I hope everyone follow me. A year ago, when I purchased the bond, it was just 5% interest, so I will get $50 a year. But now, for new bonds, government is paying 6% interest, so the new bond holder will get $60 a year. For one or the other reason, I come to know that in future, the government is going to increase the interest rate further means, like let's say 7%. Then my bond I purchased in 2022 will be further less in value, especially if inflation also increases. In those cases, I want to sell my existing valueless bond which I hold with 5% coupon. Then possibly with that money, I will purchase the future one with 7% interest. If so, then market won't take my $1,000 bond for $1,000 face value. Rather than market will reduce that bond price in equate for the 6% present coupon rate. Plus, in most cases, slight additional premium penalty based on demand and supply. For now, for understanding purpose, let's just ignore that slight additional premium penalty. So, just to represent that 6% yield coupon rate, my $1,000 bond value will drop to $833.33. For 1% increase in yield coupon rate value, my existing bond value dropped approximately $167 in total $1,000. So, I lost $167 because of this 1% increase in yield coupon rate value change. Just imagine the impact. Now let's come to the actual present world. In Jan 2022, the 10-year bond yield was traded in roughly 1.5%. So if someone purchased $1,000 bond in Jan 2022 means, then now for 5% yield, the present market bond base price value for Jan 2022 10-year bond yield is only $300. So for the person who purchased in 2022, it's a $700 loss. Similarly, in July 2020, the 10-year bond yield was just 0.7%. So the current market price of that $1,000 bond is just $140. Even 3 months ago, the 10-year bond yield was around 3.4%. So that $1,000 bond purchased in July 2023's current market price is just $680. $320 loss in 3 months to provide a competitive yield of 5% to match new bonds. Again, as I said, this is a simplified calculation and the actual bond pricing would be more complex. For that, we need to take into account factors such as bond duration, time to maturity, demand, supply, and the frequency of coupon payments, etc. More precise bond pricing would require a discounted cash flow analysis. Anyway, now this is the exact reason why Silicon Valley Bank and First Republic Bank were failed, and that's the reason market never liked the increase in bond yield. One might argue that why don't they just hold the bond for full 10 years till the maturity period? In that way, they don't have to lose the face value. To answer that, it's a good suggestion. Those who have financial backup or financial firepower will let the bond just to mature. Generally, smaller banks and smaller companies won't have those luxury. And also, this sort of things only happen during crisis, and at the same time, these small banks or small company required more money for survival as the bank customer withdraw their savings, which kind of forces them to sell the bonds in lower market price. Anyway, so far I hope it's clear why increase in yield will reduce the existing bond value and how it affects the economy and market. Now let's discuss why this treasury yield is increasing. For that, it's crucial to understand and clarify the distinction between treasury yield and interest rate hike. For those who don't know, the US interest rate or federal fund target rate, which is the interest applied to overnight loans between the central bank and the commercial bank set by the central bank. Basically, it's representing extremely short-term debt within the finance sector. The objective behind raising this short-term rate is to gradually influence the other interest rate throughout the economy. For instance, if banks are required to pay around 5% to borrow money overnight, this cost is eventually passed on to the borrowers from that particular bank. So, when the federal funds interest rates quickly increased means the new overnight short-term debts are issued at these higher rates. In line with that, short-term bond yields can rise quickly. However, long-term bond yields may not rise as fast, especially if investors believe that the rate increase will lead to slower economic growth or a recession in the future. In such scenarios, investors think that the long-term bonds are the safe haven, so there will be more demand and consequently it drives down their yield. And that's what happened in July 2023. 10-year bond yield was just 3.4%, whereas Fed fund target interest rate was over 5% and the 2-year bond yield was around 4.5%. This discrepancy between 10 and 2-year bond yield is called an inverted yield curve, where short-term bonds offer higher yields than long-term bonds. This yield curve inversion is often seen as a recession indicator because historically that's what happened all the time. For example, in the history, the grey area was the past recession and most of the time it did followed by yield curve inversion. However, in contrast to that, now we got this very good jobs data and very good GDP growth data. In addition, Fed said that they are going to keep the fund target interest rate as 5.5% for longer time. In line with that, short-term treasury yield was increased to around 5.5%. So basically, market felt no recession. Thus, the yield curve inversion starts to slowly vanish, and that's what's happening now and increasing the 10-year bond yield to increase. I mean, in July 2023, it's recession fear. So, yield curve inversion increased, but now no recession fear. So, yield curve inversion is decreasing. Meaning, instead of reducing the 2-year treasury bond yield, 10-year treasury bond yield is increasing. This is basically returning to normal over time, with long-term rates usually higher than short-term ones. So back to our question, do raising long-term interest rates, could it hurt the economy? Paradoxically, while higher interest rates can benefit banks as their net interest margin increase over time. However, the problem now is the rate of increase. In 12-15 odd months, US increased the interest rate near 5%. This rapid increase in rates now led to short-term unrealized losses on the already issued long-term fixed rate bonds. That's the exact situation with Silicon Valley Bank. It got liquidity risk when banks need to sell their depreciated assets to meet withdrawal demands. Bigger banks kind of escaped, but they do have a huge loss in their balance sheet. For example, because of this increase in interest rate, Bank of America got the loss in bond value of over 110 billion US dollars. So keeping the interest rate longer term might benefit the banks if they have financial firepower, but for the short term it will be very painful, and it got the potential to slow down the economy as well. At present, market valued the stock market based on the assumption that we can expect the rate cut at second part of the next year. But if the higher interest rate carries on, then the economy slowdown looks unavoidable. So that's all in this video. I hope today's deep dive has shed some light on Treasury yield, US government bond and US interest rate. Please consider subscribing the channel and liking the video, so it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investment based on this, as I'm not a SEBI registered advisor. I am doing this for my and viewers' educational purpose only. Thanks for watching.